Today, we're giving our 2024 mid-year market update. We'll talk about what's driving stock market returns, how the economy is really doing, and what to look out for in the second half of the year. The S&P is up 18% so far in 2024. That's one of the top 5 best first half performances in the past 25 years. Unemployment is at 4%, inflation is down to 3%. But if it's such a strong year, why is it that 55% of Americans believe that our economy is in a recession? By the way, if you enjoy these types of videos, please like and subscribe. It's free for you and really helps our channel. We talk about personal finance and investing topics weekly based on what we're learning live on Wall Street. So let's get right into the 2024 mid-year market update. First things first, the S&P, as you can see here, is up 18% year to date. That's one of the top 5 best performing first halves in the past 25 years. This is on top of a 2023 performance of 26%. This year, we've had another phenomenal start to the year, but we should probably dive a little bit deeper here. If we look at the breakdown of returns for 2024 so far, we have these 5 big tech stocks: Nvidia, Meta, Google, Amazon, Microsoft. These 5 stocks are up 59% so far this year in 2024. If you look at the other 495 stocks in the S&P, they're also having a decent year. They're up 12% so far this year. But you can see that a significant percentage of the returns are being driven by these large tech companies. If we don't just look at stock price and also look at earnings per share, or EPS, you can see again that Microsoft, Nvidia, Amazon, Google, Meta, these 5 stocks have surprised and beat expectations the most for EPS. These 5 stocks have beat consensus estimates by 38%. That's pretty darn significant. And then the other 495 stocks have actually underperformed expectations. Overall, if you weight the index, the S&P 500 has been about in line with expectations. And remember, it's really most of the time expectations versus reality which causes a stock to go up. So you can really see for these 5 tech stocks that outperformance of expectations driving the price up. And then given the other stocks are actually underperforming earnings expectations, it's just the valuation multiple that's really driving prices up. So where do we go from here? There are 2 big events to look forward to in the second half of the year. First is that we're now 4 months away from the election. And you can see here that Trump, as we've talked about in prior videos, now has a 60% probability of winning the election. What does that mean from a stock market impact standpoint? The big corporate news that people are focused on is whether Trump's Tax Cuts and Jobs Act, whether the corporate tax cuts in there are allowed to be extended. Remember, unlike personal tax rates set in the TCJA, corporate tax rates will be extended as long as nothing is actively changed. So a Trump victory in 2024 would very likely mean the extension of those tax cuts. Those tax cuts have been almost 30% of the earnings growth for the S&P 500 since 2017. That's an extremely large percentage of earnings and probably the stock market growth since then. The second thing that's an important event to pay attention to in the second half of this year is rate cuts. The market, as you can see from this treasury yield graph, is now pricing in a 90% probability that we will get a rate cut before the November election. Now, there are 2 upcoming Fed meetings. where there's the possibility of rate cuts. That's end of July, July 31st, and September 18th. The market now expects there to be a 0.25% rate cut in one of those two meetings. And why is that? Well, one, it's how the Fed has been messaging. Two, it's based on a decent amount of the underlying data. If we look at inflation rates, they've been consistently slightly above that 3% level year over year for most of 2024. That finally touched exactly 3% in June. If you think about this in context of historical inflation rates, the Fed has messaged they'd like to keep inflation at that historical 2% or lower. However, 3% is kind of reaching that level where the Fed is starting to feel comfortable with rate cuts. And we're just at about that 3. If we start to tip under 3, it's very likely the Fed will start to cut rates. And this kind of indicates that maybe we're actually in for that soft landing that a lot of people were saying might be quite difficult to achieve. In addition to inflation rates, the Fed is also paying attention to the average US consumer. If we look at some of the consumer stocks, you can actually see the consumer has weakened a decent amount in 2024. Now, this is in contrast to the low unemployment rate. You can see a few data points showing that the consumer sentiment has actually worsened a decent amount in 2024. If we look at a stock like McDonald's, for example, it's actually hit a 52-week low just in the past week. And year to date, the stock is down 14%. In general, there's been some contraction in consumer demand for these discretionary spend items such as eating out. Similarly, you can see Nike has also hit a 52-week low. Year to date, the stock is down 32%. Now, part of it is maybe some fear around Trump tariffs, but part of it is also just weakening consumer demand and weakening consumer consumption. You can also see this in the credit card data. Credit card delinquencies have now increased to the level of pre-COVID. Remember, during COVID, a lot of people received stimulus checks and there was a lot of spending and supporting of households. But now, especially among lower income households, you can see that delinquency rate has increased dramatically since COVID and actually peaked above those pre-COVID levels, which again indicates that the average consumer is weakening in terms of their ability to spend. Finally, even though the stock market has been having an incredible 2024 after a very strong 2023, most lower and middle income individuals aren't actually benefiting from this. You can see that based on this graph and the data, where you can see the stock market investments has been actually relatively flat, especially among bottom third income participants in the stock market. There hasn't been actually that much benefit. Most of the market benefit itself has been going to the top third income participants in the market. So again, that's both increasing wealth disparity, but it's also something that the Fed is paying attention to, which is the weakening of the average consumer. When the Fed increased rates, this is actually what they wanted. They wanted to deflate the market to prevent further inflation, to weaken the consumer so that consumer is spending less, resulting in less inflation in goods. What does this all mean? Again, we've had one of the strongest starts to the year during the first half of 2024 after an incredible year in 2023. Now, a lot of that growth is in these top 5 tech stocks. So there is some dispersion in terms of the top 5 and the S&P 495. But what do these events mean for the market in the second half of the year? Well, it actually sets up for a pretty constructive second half of the year. Both the election and the rate cuts provide some support for the market. The election, because Trump will likely, if elected, extend the tax cuts, which gives more certainty to future earnings of different companies. And the second is with rates at 5%, all of a sudden the Federal Reserve has a weapon to boost the economy that they haven't had for a very long time. Remember, when rates were zero or close to zero, a lot of people were concerned because if there was a recession, the Fed can't really do anything in terms of cutting rates to stimulate the economy. Now at 5% rates, there's the possibility to cut to 3 or even 2 or even 1 in the event that there's some external factor that starts to hurt the US economy. Now, that being said, it doesn't necessarily mean we're going to have another strong second half. It just provides downside protection. You have the election coming up. So one, Biden certainly doesn't want to hurt the economy and decrease his chances of election. And Trump, once elected, likely will want to again continue his tax cuts. And then in the meantime, you have the Fed, who also has a weapon now to stimulate the economy if needed. That being said, I think one question that is on a lot of people's mind is if you look at these large tech stocks, Nvidia, Meta, Google, all of these have been driving a lot of the returns for this year. And they're now at valuations that are close to their peak price to earnings ratio, meaning the price of the stock versus the earnings they actually generate. So these are at pretty high valuations at this point in time. There's an ongoing question whether there's a bit of a bubble building in these stocks. The reality is a lot of companies are spending real money on AI right now, but what's unclear is the actual return on investment of that money, meaning consumers will certainly benefit, but how much revenue will corporations actually be able to generate from adding these additional features? Right now, it's still not too clear. Typically how these things work is there's a decent amount of spend, a bit of hype and build up in terms of expectations, and then the reality is it takes longer for companies to see the actual benefit from a technology. If these large tech stocks were to fall by 10%, I think there's a decent argument that even then they're not cheap stocks. A pullback wouldn't necessarily be surprising, but it's very hard to say. I do think we're in a scenario where you have a very constructive macro setup for the second half of this year with one, the election, and two, potential rate cuts, as well as the ability to cut rates. But we could still have some volatility, and there's always the possibility of something large and external happening that we're not taking into consideration. So hopefully that's a helpful overview and mid-year 2024 update. We'll look back in 6 months and see what actually happened. Of course, it's very hard to predict where the market will go. This is just what is being paid attention to right now. Again, if you find this info helpful, please like and subscribe. It really helps us out, and we'll keep you up to date as we release more updates about the market and about investing. Thanks for listening in. I'm Nick, and I've worked in finance for almost a decade. If you enjoyed this video, please give it a like and follow our channel for future videos. You can check out our WeChat group for more wealth and retirement tips. Talk to you next time. Bye.